Hey guys, welcome back to Officer Finance. In today's video, we're going to be talking about index funds, which are my favorite types of investments. Index funds are also the best way, in my opinion, to get started investing into the stock market, especially if you're a beginner and have no idea where to start. Before we begin, make sure to hit that subscribe button so you can follow along on my financial journey. I plan on making follow-up videos that dive into my top index funds, so make sure you're subscribed so you don't miss out. And lastly, I'm not a financial advisor, and this is not financial advice. And with that, let's begin. Alright, so looking at the definition of an index fund from investor.gov, an index fund is a type of mutual fund or exchange-traded fund, which is also known as an ETF, that seeks to track the returns of a market index. The S&P 500 index, the Russell 2000 index, and the Wilshire 5000 total market index are just a few examples of market indexes that index funds may seek to track. Okay, now what the heck does this mean? Here's it in very simple terms. Think of index funds as baskets comprised of dozens, hundreds, or even thousands of individual companies that track a specific area in the market. Alright, so what makes index funds the best types of investments? Well, the first is that they track a specific index in the market. Now, what does this mean? If you only wanted to invest in a small part of the entire market, such as investing in only real estate companies, technology stocks, utilities, or just the entire market, then there's probably an index that will track that performance. Next up is diversification. Like I mentioned earlier in the video, one index fund can contain dozens, hundreds, or multiple thousands of companies inside of one fund, meaning if you invest in an index fund that has 1,000 stocks, every $1 you invest into that fund is essentially getting broken into 1,000 pieces, with each small piece going into one specific company. Index funds are the best way to diversify your portfolio, and investing on a consistent basis into one or multiple broad-based index funds is one of the best ways to build wealth over time. Let's take a look at the Vanguard S&P 500 Index Fund, ticker symbol VFIAX. Inside this fund contains the top 500 companies in the United States. And then we can see the different sector weightings inside of this fund with materials, consumer cyclical, financials, real estate, consumer defensive, healthcare, utilities, communication services, energy, industrials, and technology. And in that fund, in the S&P 500 Index Fund, here are the top 10 holdings, which the top 10 make up 27% of this fund. And these are probably companies that everybody's heard of: Apple, Microsoft, Amazon. You have your Facebook, Alphabet, which is Google, Berkshire Hathaway, Tesla, Nvidia, and JP Morgan. These make up the top 10 in this fund. Index funds are passively managed compared to an actively managed mutual fund. So what's the difference? Well, for a mutual fund, which is actively managed, there's professionals behind the scenes buying and selling, trying to buy here and sell there to get you as the buyer of the fund the best possible return, with the overall goal of outperforming the overall broad-based market. These are people who have advanced degrees in finance and spend day in and day out doing research from companies and other funds to try to figure out what companies and what funds to put in the mutual fund to give you the best possible return. Index funds, on the other hand, are passively managed. There's no professionals behind the scenes. They simply track the index that they're associated to, so you will get the same performance of whatever sector that it tracks. Now, with that explanation, why would you want to invest in a passively managed fund versus an actively managed fund? Well, one of the reasons is the fees, also known as expense ratios, which I'll get to in a minute. But the other reason is that the overwhelming majority of people who invest in mutual funds will underperform the broad-based market that an index fund will track. So essentially, by investing in an index fund, say the S&P 500 index fund, you're outperforming over 90% of people who get their degrees and pretty much spend their entire careers studying and managing people's money. Next, I'll briefly touch on expense ratios. Expense ratios are also known as the fees that are associated to investing in certain index funds or mutual funds. Mutual funds typically have a much higher expense ratio because, again, there's people behind the scenes that are buying and selling. So an expense ratio are the fees pretty much paid to those professionals. Whereas in an index fund, there's low expense ratios because it's passively managed. But keep in mind that the expense ratios might only represent a couple dollars here or there when you're first starting out, but over time, decades of compounding, and those accounts grow to tens of thousands, hundreds of thousands, or even millions of dollars. In annual expenses for an actively managed fund, you might be paying tens of thousands of dollars a year in fees alone that will eat the growth that you've accumulated over time. A lot of index funds will have ETF alternatives. An ETF is an exchange-traded fund, which is essentially an index fund that trades the same way as a stock on the stock market. Typically, index funds, if you buy any time of the day, that sale is going to execute at the very end of that trading day, regardless of what time you place the trade. It's always going to execute at the very end of that trading day. Whereas an ETF will execute at the time that you place the order. So if you place an order at 10:30 in the morning at a certain price and the ETF is that price, it's going to execute at that same time. ETFs can also be an attractive option over the index fund because with the index fund, there's usually a large barrier to entry, meaning you need to put up upwards of maybe even a couple thousands of dollars in order to invest into that fund. But with an ETF, you can buy it with as little as $1 if the brokerage you have does fractional shares. You don't need that large barrier to entry. You can invest with as much or as little money as you want. Alright, so this one's pretty self-explanatory. These are ideal for all types of retirement accounts due to the diversification and the low fees associated. You're not putting all your eggs in one basket, and since it's passively managed, say you invest in the S&P 500, if one of those 500 companies goes bankrupt or goes under or doesn't perform as well to be in the top 500, then it'll automatically be replaced by the next one up. So you don't need to worry about picking individual stocks that you think are going to perform well. The fund will do it all itself. I already touched on this one earlier, so I'll keep it brief. Passively managed index funds outperform actively managed funds over 90% of the time. And lastly, these types of investments require very low maintenance on your part. You can literally set it and forget it, revisit it in 10, 20, 30 years, and you'll probably thank yourself that you started investing. Automating your investments is also one of the best ways that you can build wealth over time. You can have it set to a weekly, bi-weekly, monthly, or whatever investing schedule that fits your strategy. And you don't need a large amount of money to start with. You can start with any amount. The important thing is that you start. And that's my crash course in index funds. Guys, if you found value in the video, consider liking it and subscribing for more content like this. Let me know in the comments below if you guys are invested in index funds or any types of investments that you are. Thanks for watching, and I'll see you in the next one.